is the stock market still worth the risk, or is cash finally king again? Well, today's audience requested ETF battle is between VOO against SGOV. It's a battle of risk versus stability. Who wins? Stick around for the answer. Welcome to ETF Battles. I'm Ron DeLegge. This is the place we congregate to analyze and judge ETFs. Keep your awesome and excellent ETF battle requests coming. Send us your ETF ticker symbols in the comment section below, or join our community by hitting the subscribe button. Today's program is sponsored by Direxion, and they just rolled out 4 brand new single stock ETFs with 2x daily exposure to Adobe, PayPal Holdings, Texas Instruments, United Healthcare Group, and many more. Be sure to explore the full lineup. Head over to Direxion.com. We also have links in the description section. So today's ETF contest was requested by a viewer named 100 Toe Face, and it's between VOO from Vanguard versus SGOV from iShares. This contest is all about risk on versus risk off, and really more than just ETFs versus each other. It's really a market outlook question that needs to be answered. Helping us to do that, we've got the analytical prowess of 2 of the best in the business. We've got Mike Akins at ETF Action and Tony Dong, independent ETF analyst. Guys, great to see you again. Welcome back.
Thanks for having me back, Ron.
Great to be here, Ron.
So we've got our 4 battle categories: cost, exposure, strategy, performance, and mystery. Mystery, of course, is where you can pick a certain factor or thing that you feel is pertinent to today's contest. Judges can also nominate wildcard ETFs. Keep in mind, none of the battle outcomes on this program are ever predetermined or known in advance by myself or our judges. The first category is cost. Mike, please get us started.
All right. I mean, we're talking about 2 very unique products here. So they're both, from a cost perspective, they're both cheap. They're both liquid. I can't give it a winner because they're both excellent vehicles for what they serve. So we can move on.
Split decision. Thank you, Mike. Tony, you're up next. How do you see it in terms of cost?
Well, just in terms of headline expense ratios, SGOV is 3 times as expensive as a VOO, but that comes with a caveat. 3 times is 0.03% a year, where 3 bips is just 9 bips, which in the grand scheme of things is not a lot. They're both highly liquid too. VOO is the largest US ETF, a lot of trading volume, not as much as SPY, but enough to give it a 0.01%, 1 bips, 30-day median bid ask. Same for SGOV. You put 2 and 2 together, I'm going to give it a VOO. Expense ratio is just super cheap for what you get. But worth noting that it's not the lowest cost S&P 500 index ETF out there. That would go to the State Street Investment Management, I think S&P 500 portfolio ETF. They just changed the ticker to SPYM. It undercuts VOO by 1 basis point at 0.02. But bring it back to these 2. VOO is cheaper than SGOV for sure.
All right. Well, that shifts us next to exposure strategy. And you're still up, so break it down for us, Tony.
Yeah, so a lot of people get confused about the S&P 500. They think it's just the 500 largest stocks in the U.S., but the index is actually a bit more curated than that. So there's requirements for market cap, liquidity, but also earnings consistency. And what a lot of people don't realize is that there's a bit of a committee process in there that determines which stocks get added or dumped. And that's why you see so much news about the S&P 500 reconstitution and new index additions and so forth. There's a human element in there, so it's actually quite curated. SGOV, on the other hand, is pretty simple. You have a evergreen portfolio of treasuries trying to maintain a 0 to 3 month target duration. As treasury bills mature out, they get rolled out the portfolio, new ones rolled in. This is one of the reasons why, you can't really hold a traditional treasury bond ETF to maturity. But given that the maturities for this one are so low, the effective duration is just 0.11 years. So you're not going to get hurt when interest rates rise. In fact, when short-term rates rise, SGOV's yield is going to kind of move in lockstep with that. Right now, with the Fed holding, we're looking at a 30-day SEC yield after that expense at 3.55%. Whereas I just saw a metric from Meb Faber that the S&P 500's dividend yield has fallen to an all-time low of 1.1 as more firms prioritize buybacks. The index prices run up so much, and a lot of firms are doing heavy AI capex. So in terms of exposure, I'm not betting against the U.S. stock market. Warren Buffett said it best. You have 500 market cap weighted companies that are all already screened for size, profitability, and liquidity. It's market cap weighted, so it's going to be able to let winners run. And I think long term, like, yeah, I'm going to take equities over the risk-free rate. So for me, exposure goes down to VOO.
Thank you, Tony. You're up next, Mike. How do you see it when it comes to exposure strategy?
They both do exactly what they're saying. The S&P 500 is a little unique right now. It's a little, it's gotten a little expanded top heavy, as all market cap weighted indexes have, and I think that's something to pay attention to. Whether it's the S&P 500, the Nasdaq 100, you name it. If it's market cap weighted, the size issue has become real, especially in the United States, which all these are. But other than that, the S&P 500 is fabulously way to invest in the market. I think Warren Buffett has said it numerous times, but if you're really just out there and you want to invest your money, own, SPY or VOO or IVV or one of the S&P 500 products, and you'll be great. SGOV does exactly what Tony does. I think it's what's really unique about all of the fixed income ETFs that have come out there, the precision tools. SGOV is essentially cash, right? You're getting 0 to 3 treasuries. You have no risk unless you think the U.S. government's going to default, because there is no duration risk on a 0 to 3. So it's like holding cash. Right now, you're getting paid 3.5% to do that. That changes. It will, you will change with that as interest rates change, or the Fed makes any changes, or risk goes up or down. So to that extent, it's not providing the traditional benefit of having the idea of like pairing equity and fixed income. Part of the reason you pair equity and fixed income is because you want some duration risk, with the idea being that when equities get in trouble, the market's in trouble, interest rates come down. As a result, you get a boost to your fixed income holdings. There's that diversification effect. It helps lower your risk profile. When cash is obviously going to do it. So from cost exposure, I think they're both great strategies. They both deliver what they're supposed to do. I believe the question was, what do I have to hold for 2 years?
Yes, that's right. For 2 years.
I'm going to take that to mean that I need the money in 2 years. And if I need the money in 2 years, there's no way in hell I'm holding 100% of my portfolio in the S&P 500 right now. I would never do that. If I need the money in 2 years, it's going to be in cash or something like that. So I'll take SGOV based on the way the question was asked, but don't read that into anything other than what your viewer was asking.
It makes sense, and great analysis. Thank you, Mike. Now we shift to performance, and Mike, you're still up, so break it down for us.
Yeah, so let's talk about performance, right? Obviously, the equity markets have been awesome the last decade. They've been 8+% returns since the S&P 500 has been around. It's an proven way to grow your wealth is to take a low-cost index product like VOO and allocate to it and let it grow. So there's no question here. VOO is the winner. It's a winner by a mile. But let's talk real quick while we're doing that about drawdowns, right? So you are going to have no drawdown with SGOV, but just quickly, if I pull up VOO and let's just say since inception, I'm going to pull up since inception. So VOO has been around since early 2000s. You had drawdowns of 40+% in this product, right? So the markets do correct. We do go into bear markets. It does happen. I know people don't believe it, but obviously we're talking apples and candy bars when it comes to comparison here of these two products. And so to get paid to own the S&P 500, you are taking on almost infinitely more risk than you would be from just holding cash in SGOV. So performance, no brainer. For me, VOO, but risk adjusted returns, and I have to have this money in 2 years, I'm still going to take SGOV.
Mike, great analysis. Thank you very much. Tony, you're up next. Break it down for us on performance. How do you see it?
Yeah, well, rearward looking, VOOs absolutely smoke SGOV. That's what happens when you take on equity risk versus just earning the risk-free rate. I will note that, to Mike's point on drawdowns, there was almost a 10-year period from 1999 to 2008 where the S&P 500, after inflation, was negative. So cash beat it, the Bloomberg Aggregate Bond Index beat it, emerging markets beat it, international market, basically anything but large cap U.S. stocks did okay during that period. So if you have a repeat of that, SGOV isn't a bad place to hide. If you have a near-term purchase in 2 years, like a down payment, you got a wedding to pay for, Yeah, SGOV is great. It's a great alternative to a money market fund. You don't get locked up like a CD is, but you don't have that insurance. But in practice, it's treasury bills, borrowing a sovereign default, which I don't think is likely, but treasuries did get downgraded to AA. This thing's as safe as it gets. If I had to pick one for the next 2 years, I'd probably still go with VOO because I would just hedge it with options. I'd sell like a put spread or something, buy 5% out of the money, SPX index put, sell the 20% out of the money put, and then sell like a 3 to 5% out of the money call and just collar that. Just float along, participating in some returns. But if you don't want to do that yourself, there's a lot of buffer ETFs and hedge ETFs that do the same thing, but are benchmarked to the S&P 500. But they will cost you fees if you don't want to do that options yourself. But I digress. Back to my point. I think for performance, VOO still takes it. It's really hard to argue against the S&P 500.
All right, we've moved to the mystery battle category where our judges can give that certain factor or thing that they feel is crucial. It is mystery because we don't know what it is until they tell us. So, Tony, what is your mystery battle category and which of these ETFs wins it?
Yeah, it's provider reputation. So Vanguard is a cooperative owned model. The shareholders in their mutual funds are also, participants in the company. So there is an incentive to lower fees over time. And if you look at this trend of fee compression we've seen, Vanguard has been at the front of mostly all of them. When you see Vanguard lower expense ratios, other providers will follow suit. iShares is run by BlackRock. They're a profit maximizing corporation for their public shareholders. If you own shares of BlackRock, it's been great. But even though their fees are low, they don't have that same incentive that Vanguard does. And they tend to be a laggard when it comes to fee compression. So, if I'm thinking about which provider I want to have my money with long term, I think Vanguard is the one that has historically been more aligned with investors. And just one more thing I wanted to make readers aware of, or listeners aware of, it's not an all or nothing choice. Like Warren Buffett's portfolio for after he passes away for his estate is 90% in an S&P 500 index fund, 10% in short-term treasuries. You can achieve that very easily with 90% VOO and 10% SGOV, or you can alter it as you wish. But to your point, Ron, it is important to know that this will not improve your risk-adjusted returns because cash, like you said, has no duration risk. Ideally, you want something that is negatively correlated with stocks and has a little bit of duration. So, some people use the Bloomberg aggregate. Some people use TLT and long-term bonds that can help you during years like COVID and hurt you in 2022. But straight cash is just going to reduce returns proportionally with your risk. And so you're not going to get a better Sharpe ratio out of that. But 90 VOO and 10% SGOV is probably one of the better portfolios for ETFs I've seen recently. But to bring it back to my mystery factor about the provider, VOO wins it again. I like this ETF. I don't use it, but it's the biggest ETF in the world for a reason.
Mike, you're up next. How do you see it in terms of your mystery battle category? What is it and which of these ETFs wins it?
Yeah, I think Tony started to allude to it there, but I was going to say that, maybe draw us an age scale. And if you're 90 years old listening to this show, and you want that money to be where it's at and stay, own SGOV. If you're 20 years old and you're watching this show, it should be in VOO 100%. And then if you just draw a line across that, you should probably start reallocating along that line across the years, right? I mean, that's how it works. If you run any sort of Monte Carlo simulation and think about, financial planning, the idea is that you get more risk averse as you get more wealth and as you have a more immediate need for that wealth. So this conversation is a good one in the terms of, 2 years from now, there's no way I've been in this market for too long to know that if I need that money in 2 years, that I'm letting it being naked exposed to the market. I've seen some massive drawdowns in my day, as most viewers have. It will happen again if you hold the course, and I believe that you'll be rewarded handsomely for not selling when things are bad, when there's blood in the streets. But for 2 years, SGOV has to be my winner. But I think my mystery category is kind of like, Tony said, think about how do you own them together. I prefer to own a little bit of duration risk because I think it's a better diversifier. But owning cash as a diversifier does work quite well. And SGOV is a very efficient way to do that. So like both products, interesting conversation. But for this particular mystery category, I think it's it's all about using them to diversify based on your need, based on your timeline of when you need those assets.
Makes sense. Thank you, Mike. And now we've moved to the part of the program where our judges are going to give us their overall battle winner. How will this go down? Mike, give it to us.
Yeah, my overall winner is SGOV in terms of the question as it was asked. I am not, I'll bet on a basketball game here and there or football game, and I like to gamble, but I don't gamble
So
with
you're the
my
guy manipulating Polymarket's
yeah,
marketplace. But I
exactly.
knew it was one of you ETF battle judges.
But I don't gamble with my true financial stakes. And if I need that money in 2 years, there is no way I'm nakedly giving it to the market. I would put it in SGOV in this battle.
Thank you, Mike. Your final chance, Tony, to weigh in with your overall pick.
I'm still going to go with VOO even for the next 2 years. I mean, if I have a defined like liability in the next 2 years, I'm going to assume that I'm just going to set aside a cash wedge in something else, whether it be CDs or a money market fund. If it's like how I'm going to allocate my personal portfolio for the next 2 years, I think it's a smart idea to be long equities. Jeremy Siegel wrote stocks for the long run. I think in 2 years, or in 2 years, 5 years, 10 years time, that on average, the U.S. stock market, the companies in the U.S. stock market are going to sell more products to more countries, to more locations. They're going to pioneer more services. They're going to buy back more of their shares, pay more dividends, reinvest in things above their hurdle rate. There's going to be winners and losers. But when you have a market cap weighted fund like that, the winners rise to the top. And to be able to own that for 3 basis points a year, that's pretty good. And the tax efficiency of VOO is also amazing. And I think that, to bring it back to my point, yeah, you can risk off in cash too. But if you have the options shops out there and you own like something like VOO, it's not a big leap to be selling index options or buying and selling different spreads to hedge your risk over the next period. You get some defined certainty out of that, and you're not forced to sell out of your position and realize capital gain. So I think that's one of the advantages of using options to hedge while staying invested in a benchmark.
Well, our judges have spoken, and according to today's battle scorecard, this is a split decision with SGOV being Mike's choice. And he framed that in terms of the actual question from this viewer, Eric, over the next 2 years, which would he hold? And clearly SGOV was his vote just from a principal protection and not knowing what's going to happen over the next 2 years. SGOV for Mike was the winner in that regard. Tony choosing VOO as his choice and saying, well, listen, maybe you hedge some of that position with some options. For those of you that know how to do that or can do that, that was an interesting way of going about it. But also to Tony's point, he mentioned that, 1999 to 2008, there was a period there, and it's been quite some time. We've forgotten where, equities did underperform after inflation. And so we just have to be aware that those moments can strike at the least opportune times. And so we definitely want to be ready as investors for anything. And certainly, it's never about necessarily all this or all that, but having a diversified mix. You don't have to have one or the other, as our judges pointed out. They can work together just fine. It's up to you to find the right balance. So great job to both of you, Mike and Tony. Thank you for your outstanding analysis, and keep up the good work.
Thanks, Ron.
Thanks, Ron. It's great being here.
Be sure to get in touch with our judges. I've got links to both of them. Get in touch in our description section. Also links to our program sponsor, Direxion. I'm Ron DeLegge with ETFguide. Send us your ETF battle requests in the description section below. Give me your ETF ticker symbols. We'll see you on the next episode. Thanks for watching.